Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets, and analyse the issues impacting the Kiwi economy. Let's get into it.
Kia ora and welcome to Markets, Mystics and Mayhem. This is our 6th episode, and what an episode. I tell you what, we've had some really good news come out in the last few weeks. Rate cuts are coming through thick and fast. The Reserve Bank is playing ball, and we're seeing expectations for growth next year improve. So we've seen a few rate cuts, and that's great. And it seems to have snapped people out of their recessionary mindset. We've seen businesses sort of lift their heads and start to think about 2025 and 26 as a much better year, as a much better period. And I think we can put the stake in the ground and say, this is the end of the recession. We're going to see some growth next year. What we're going to do in this episode is we're going to have a bit of a chat about interest rates and what's happening with the economy. And then we're going to bring on Weston, who is our head of balance sheet. So works in our Treasury, lives and breathes interest rates, and is going to tell us all about the wholesale market. So let's get into it. So we've had a few rate cuts from the Reserve Bank, and their recent decision was to cut 50 in one go. Of course, we're now expecting them to do another 50 and get interest rates lower faster. And it's good news. It really is good news. So I'm going to hand over to MJ and I want to get some insights as to what these rate cuts mean for our economic forecasts. MJ, take it away.
Yeah, I think with the Reserve Bank going 50 and we're expecting a follow-up 50 in November, it just means we're removing that restraint in interest rate settings. And what that does mean is that our forecast for a turnaround in growth next year, I think it just cements it. I think we are going to see that turnaround in our activity levels and confidence. It just cements the increase we've already seen. So, for households, that means lower interest rates means more money in their back pocket, and that should fuel, add a bit more activity in the housing market in general. So there should be a bit more life in that space. For businesses, lower interest rates also means that they can sort of plan for next year with a bit more confidence. They know that when they're thinking about investment intentions and what they want to do next year in terms of expanding business or, investing in new plant and machinery, all those discussions can be made, with more confidence because we know that interest rates are headed lower and they're heading there much faster than, we probably expected earlier this year. So there's that growth momentum is starting to build. That confidence lift that we've already seen in numerous surveys, that'll just continue. And really 2025 should be that year of growth. And we're saying that now with more confidence.
Yeah, absolutely. And one of the cool things about our gig, MJ, is that we get to run around and speak to a lot of businesses. I've had immediate feedback from many businesses that these rate cuts, now that you've actually seen them, that they're real, they're being passed through, and businesses are actually looking, oh wow, okay, not only have interest rates peaked, there was discussion whether they could go up or down. Now they are going down, and it's a matter of how far. So the feedback I've had has been pretty immediate. Had I given a presentation in July, the feedback was generally, thanks for the optimistic presentation. You're telling us that interest rates are going to fall, but these are all the problems that I face in a recession right now, and this is what I'm focused on. Whereas my presentations over the last few weeks have been, yeah, we get it. Rates are declining. Let's look to 2025 and beyond. So businesses have lifted their heads, which is important. Confidence has picked up. And I think the key is, when does it actually feed through into activity? MJ, what are your thoughts?
I think this time around we could see this transmission of rate cuts relatively quickly because we've seen, the mortgage book, lots of people have positioned themselves for the shorter rates, and that's coming through already. They'll have rates lower than where they are today in, the next 6 months. So I think this pass of rates could actually be much faster. Usually monetary policy operates with about a 12 to 18-month lag, but I think this time around it could be faster, money back in the pockets much faster.
Yeah, absolutely. So, what's our call for growth next year? What's our call for asset markets? Particularly housing.
Housing, we're sticking with a call for about 5 to 7% gains next year. There are risks to the upside and to the downside of that. But so I think that seems like a nice conservative forecast there. For growth, I think we see it, the sort of economic picture kind of turning second half of next year. We start to record getting back to the average levels of 3% growth. That'll be 2026. But that's a much better picture than where we are now, where we've had 2 years of recession. Our economy's been operating below its capacity for a really long time. But now we're seeing this ship turn.
So much of our wealth is tied up in housing. It has a really, really big impact on our psyche, on our confidence. So if house prices are rising next year and into 2026 and beyond, that's going to feed through to household confidence straight away. But it also feeds into business confidence, because there are a lot of small businesses out there that have loans linked to housing as well. So it also impacts business confidence and confidence more broadly in the economy. I mean, how much of that house price forecast sort of feeds through to your thinking on the rest of the economy?
Yeah, I think quite a lot, because of how dependent or how much its influences on confidence throughout. So when we see a much stronger, housing market, we do tend to see quite strong growth, because you have a much more confident consumer. They spend a bit more when your house prices appreciate, and then, as you say, with businesses as well, when that sort of asset starts to appreciate too, there's a bit more confidence to them to think about what else they can spend and how else they can expand their business. So it does matter for the economic outlook, and that is part of the reason why we are expecting the economy to turn around next year. But yeah, 2025 should be that year of growth, and we're a bit more confident saying that now.
Yeah, and within that housing market, I think the missing piece has been the investor. So investors in housing have been hunted by policymakers in prior years, with the removal of interest deductibility and bright line tests and all these things that were brought on to slow the housing market down. Those have been reversed. Investors are still on the sidelines, but once they get an idea that house prices are rising, they'll come back into the market, and that's key. That's key for the economy, and it really does solidify that turnaround in activity. Well, now we're going to hand over to Ross Weston. All right, welcome back, and we're joined by Ross Weston, our head of balance sheet. Ross works in our Treasury. For anyone who's worked in a bank will know that the Treasury is by far the most important function in a bank. But to get a bit more insights, Ross, why don't you tell us, what do you do? What on earth do you do for a living in a bank?
Yeah, the balance sheet, it can be a bit of a monster sometimes, but yeah. So we basically look after the liquidity of the bank, and that's just to make sure that the bank has a constant stream of money coming in versus money going out. And then, I guess the other side of it is looking after the interest rate risk of the bank as well. So making sure that we're not exposed to interest rates going up or interest rates going down. And most of that is in relation to, lending out money long and borrowing it short via term deposits. So that's the most simplistic way I can sort of describe it.
Yeah, well, I mean, like you say, we take money for a short period of time, don't we? We take term deposits for like a year, but then we lend it out on a mortgage for what, 25, 30 years. So that's a curve play right there, isn't it? And the risk, I guess, for the bank on interest rates, if you're receiving a mortgage rate, a fixed rate, and you're paying a term deposit rate, I guess you're managing that risk, right?
Yeah, exactly that. Yeah, and I guess at the moment, most mortgage holders are tending to fix for a short amount of time as a result of what the Reserve Bank are doing. But we'll get to that. They're outside cuts, and so fixing for longer at the moment doesn't seem like the thing to do for most customers. So like I say, most of them are fixing for like 6 months or 1 year. But we are getting some offset to that interest rate risk management via term deposits, which are generally short as well, and most of that is 6 months and 1 year at the moment. So that means that there's not a whole lot of interest rate risk management to do as these flows sort of net off. But that's certainly not always the case. There's a whole back book that's sitting there, constantly repricing. And with these outside moves from the Reserve Bank, that creates a fair amount of risk to manage as well.
So speaking of outsized moves from the Reserve Bank, we've seen a 25 basis point cut, a 50 basis point cut, and now I guess we're all gearing ourselves up for the hope of another 50 basis point cut. What have you seen in the markets? How have they traded? How have they reacted to these outsized moves, as you say?
Yeah, it has been really interesting. It's the market sort of behaves like a small child at times, right? It was sort of right with the 25-point cut, it was right with the 50, and now it's sort of calling for blood, right? It's we've been right, and then the upcoming meeting in November. The market is just gently sort of toying with the chance of a 75-point cut. As of this morning, there are, depending on where you look, there were sort of 52, 53, 54 points of cuts priced. So it's this very much all about this forward delivery and this front loading of cuts that's being priced in. But I think it's sort of like a robbing from Peter to pay Paul. It's this thing of delivering a lot of forward cuts at the front, and then that means that there's going to be better times down the line, and that's reflected in the shape of the yield curve. So short end rates are lower, and the long end rates sort of rise on that expectation that all this cutting is going to work, and it's going to work quickly. So we end up getting a steeper yield curve, which all that means is just a fancy term for is longer rates like 3, 4, and 5 year rates are higher than your 2 year rate or 1 or 2 year rate, and all that means is it's steeper. But yeah, certainly incredibly interesting times.
Yeah, it's been a massive move. So just on the opposite of that, when central banks hike interest rates, those short-term rates lift above the long-term rates, and the curve inverts, and that's considered a signal from the market that a recession is coming. So we've had an inverted yield curve for how long? 2 years. It's been a while.
Yep.
Signaling that we're in a recession. But what you're saying is now it's reversing. It's normalizing. Those short-term rates are coming down. Long-term rates, that's good, right? Like, it's good that these rates are coming down and providing relief, but it's also good that the longer-term rates are lifting a little bit, effectively pricing in more growth over the longer term. So kind of want to see this steepening in rates, yeah?
Oh, absolutely, yeah. In fact, for the first time, and I think it's over 2.5 years, we have a positive curve between 2 year and 5 year. That has now changed. Now, that's not only a result of what's happening in New Zealand. That's also a result of what's going on predominantly over in the US. We're talking about a sort of a harder landing here. We're front loading, a lot of cuts, whereas over there they're talking about a more of a softer landing. And what that's doing is that's causing global yields to rise. And that is flowing through to our market as well. So that's lifting up. We're getting the downward pressure in that very short part of the curve, but we're getting a rise as well from global rates out in that longer, 5 to 10 year part of the curve as well. So there's sort of two forces going on at the same time.
MJ, there's been some good news out of the States. What's happening there?
Yeah, we're really, we're all this whole Goldilocks economy that every sort of economy strives for. It looks like the US might actually achieve that. They've had really robust jobs data out, for the last month. Inflation is, it's starting to stabilize, so things are getting better over there, and their economy just continues to grow. So there is this idea that they have a more softer landing than many other economies, ours included. So I think off that, especially that payrolls print where we had 250,000 jobs created in the US over a month. That was 100,000 more than expected. And the unemployment rate actually fell in the US. So, that really robust labor market. And off that, we've seen some pretty extensive repricing for the Fed. And I think that's what we've seen with the yields rising. So, Ross, what happened and how is that influencing our rates here?
Yeah, that jobs number out in the US was huge. It basically led to a near on 20-point rise in yields and expectations. So November, pre when that non-farm payroll was released, was there were 34 points of cuts priced in. Post this is for the upcoming meeting in November. Post that release, there was only 22. So there were 12 points just evaporated straight away. But more interestingly, in December pricing, about 20 points vanished straight away. So yeah, quite a big change in expectations, and that's exactly what you're talking about, and that that caused global yields to rise and had that biggest impact on our curve. In fact, that was the point that the spread between 2-year and 5-year that we got to positive, i.e., meaning the 5-year rate was higher than the 2-year rate. So that was a big part of the steepening in the curve. So although our short rates are being held down by what's happening domestically, they're a very strong driver of them, of the long end rates. 5 to 10 year is what's happening offshore.
What are your thoughts on that interest rate differential? Does it just continue to go the way it's gone with US yields higher, ours lowering?
I think so. I think the interesting thing going on there is this sort of long, sleepy summer we have here in New Zealand. It's the last meeting is in November for the Reserve Bank, but in between times the Fed are awake at the wheel, right? They're still meeting. They meet in December and January, and we do nothing. And that's sort of leading to this expectation about the outsized cuts that might be delivered, and it's sort of along that same sort of theme is that leading markets to think here in New Zealand there'll be another 50-point cut, because it's just sort of front loading and keeping pace with what's happening globally, particularly in the US. And of course that all flows through to what's happening in currency markets as well, that that differential, that yield differential, which is a huge driver.
Yeah, it has been quite interesting. We delivered in August. You could argue that was, it was ahead of the Fed. They did 25. Then the Fed sort of leapfrogged the RBNZ, delivered a 50, and now we've delivered a 50, and then they might go. And that interest rate differential is quite fascinating. And we've had a few FX people on this podcast, and I like to say you just need to talk rates, right? There's FX is just two interest rates. Come on, we don't need an FX strategist for that. But yeah, I think it's interesting that differential has worked out the way it has, and the Kiwi, believe it or not, has finally just started to come under some downward pressure.
Yeah, exactly. Yeah, it's in fact, as you know, it's right across all the currencies as well. You look at Aussie, we're going to get close to the RBA cash rate, fairly soon. In fact, we'll be below it if they cut by 50, right? 4.35 RBA. Post if the RBNZ deliver another 50, we're down to 4.25. So things like that start to become important, right?
Yeah, definitely. And if our currency is declining against the US and Australia, MJ, what's the first thing that comes to your mind when you think of that?
Inflation.
Okay, what's the second thing that comes to your mind?
Oh, New Zealand goes on sale. Our exports are much more competitive.
No, you're right. You are right. Declining currency does kind of take a bit of that disinflationary force out of the tradables, imported inflation. But, for me, our exporters, screaming out for a bit of assistance and getting that sort of assistance.
I think the next question now we're all debating is where's the terminal rate, the terminal cash rate? We can kind of meeting by meeting discuss what we think it's going to be. Is it 50 or 25? But now I think the question markets are grappling with, which seems to be very fluid, is where will the cash rate settle? So Jared, if we start with you, where do we think it's going to go?
Well, we kind of agree that neutral is around that sort of 275, 3 type level. And we've just penciled in, a rate cut all the way to 2.5, just to get on the lighter side of neutral, because I do think we need a little bit of stimulus, but that'll be debatable next year. And, Roscoe, I'm interested in your thoughts. I know the market's been bouncing around to the 2.5 to 3, I think, but, where is it now? Where do you think it settles?
That's the most amazing thing, right? There's all this conjecture around the front end about, are they going to do 25s, 50s? When are they going to do them? All that sort of carry on. But, through all that, what sailed through is the most consistent is that terminal rate pricing has been between 280 and 3%. It's been relatively stable. And that's in an environment where market commentators just can't agree. Across the banks, it's crazy. Some are at 375, some are at 2.5%. It is a massive difference, and I think that sort of shows exactly what's going on. I just don't think we're going to know what the OCR needs to be until we're actually there. It's one of those sort of situations, right? Because you're unwinding such a massive experiment that you don't really know what's going to fall out on the other side. But at the moment, like I say, the market is settled 280 to 3%. That's that sort of range.
Yeah, and I would agree with it. I think that's fair. I mean, I know some are saying 375, but they're probably in the camp that don't think you need to go all the way back to neutral. That might not be their neutral setting. And the same with us. We're saying 2.5, but we sort of concede that neutral is probably above that. We're saying we do need a little bit of stimulus. So with those quite wide-ranging views, it is interesting that the market is quite stable around 280 to 3, and I certainly wouldn't disagree with that.
Yeah, I think the other thing as well is that a 475 OCR is still restrictive, and the RBNZ have brought that up. Now they keep saying this is still restrictive. So we've got a long way to go to get down to something that is even stimulatory, I think, at the moment. So yeah, there's a fair amount of work, sort of wood still to chop.
Yeah, agreed. Let's leave it there. That was fantastic. Fair amount of wood still to chop. Quite a few cuts still to come through, and markets, trading reasonably well by the sounds of things.
Yep.
So, thanks for joining us, Roscoe. It'd be great to have you back on in the future. That's it for this week. Thank you for tuning in. Please subscribe, please follow, and we'll be back next week. Thank you.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.